and thank you, gentlemen, for being here on the panel. As you could all gather from the profiles of the very erudite panel that we have, it's a very expansive experience set that we have, straddling from alternates, from private markets to public markets. And I was interacting with some of the investors, some of those who are in the process of setting up family offices. And I could gather that many of you are looking at solutions how to set up investment strategy, asset allocation. There's a lot of exotic stuff that gets thrown around. And we're hoping that we'll be able to demystify some of these aspects. Also, we were hoping that we'll focus a little bit around risk. A lot of clients or investors that at least I meet, there are a lot of scars of the back of the 2008, 2009 era. And a lot of questions are, when does it get frothy? And what are the aspects of risk that I need to be cognizant of? So I just wanted to start, we have VT here with us, who brings with him a lot of private markets expertise. VT, I was reading in the Economic Times today morning, there's a company called Tencent, a market cap of $180 billion. And obviously we've seen all these mind-boggling valuations. A lot of our family office clients get approached directly or indirectly with several such transactions which are private in nature. So my question to you is, does it make sense, given that India's macro is so good, public markets are expected to do well, should family offices look at private investments at all? What risks they have to be cognizant of? And what's your outlook? Where do we go from here? And who can we compare with?
Thanks, Anshul. So 30 seconds on Sequoia Capital so that you have the context for my view and our house view in terms of how do we look at private markets. So we've been in India for 8 years. We've invested close to $1.5 billion in 80 plus private companies. And typically these are two types of companies. This is companies which are really in the early stage, sometimes no revenue, sometimes just a business plan, sometimes it's just a team. Or it could be a business which is small to mid-sized, maybe 30, 40 crores of revenue to 150 crores of revenue in an interesting space. And we focus only on 3 sectors, so consumer, technology, and healthcare. We've been doing this for 8 years now, and our experience in India has been quite promising. We have offices in China, US, and Israel. Of course, China and US at this point of time, both in the venture world and in the early growth world, the outcomes are pretty overwhelming compared to what we have seen in India so far. But what I would certainly urge family offices to do is to make sure that they find a way to participate in private markets, especially in the venture and early growth phase. Because this is frankly one of the most exciting spaces in India. And over the last 2-3 years, the trends in technology worldwide, including these are oft repeated ones, but the numbers are quite staggering in terms of internet penetration in India, growing use of smartphones, mobile penetration, along with changes in the way software is created and delivered across the world, are all creating big opportunities for Indian companies. Some of it will be targeted at Indian markets and some of it will be targeted at global markets. But it is very important that Indian companies or Indian investment offices find a way to participate in it, because right now, most of the individuals I see in the market participating are investing through angel networks at almost at an individual capacity. And the private markets are pretty much shut because most of the venture capital in India has raised money from institutions. Like we have institutions in the US and the UK primarily, who have invested in our funds. So there is a big gap, and then of course after that you get a chance to participate only in the public markets. And the reality is that there is tremendous value creation in early stage, and therefore if you miss the chance in the venture in the early growth environment, then it can prove to be one of the colossal loss and returns. China had a very similar problem 7 or 8 years back, but they have systematically solved for it. So a lot of the venture capital and early growth capital chasing opportunities in China has been funded by family offices, insurance companies, and a whole bunch of Chinese companies. And therefore that has provided an opportunity for them to participate in private markets. So I think that would be my view, and that's our house view at least. We've been very bullish on India, especially in 2011, 12, and 13. Last year was the year we invested the most we have ever invested in the last 8 years. So therefore, I would say that is something that as family offices you should think about very closely and make sure that you participate in. Otherwise, there will be a big part of value creation that you will miss.
So in terms of this, there seems to be so much of dry gunpowder waiting for these transactions. So do you think valuations are going out of whack? Do you still believe it's an opportune time to evaluate these opportunities?
See, on the venture and the early growth, when you say high valuation, right, the difference will be whether you're investing in a company at a valuation of 60 crores or 150 crores or 200 crores. That's the real way to think about investing in some of these companies. Or you may end up investing in a company at a valuation of 400, 500 crores. And of course, at that point of time, you're evaluating, it will look very early. So in such cases, the real question to ask is this company disruptive? Is this company, does it have a potential for creating very significant market cap because of either technology or what they're doing? And there the answer is yes. Then this entry valuations, especially in the early growth and private equity space, early private equity space tend to matter less. It's more important as to how big an opportunity can get created, as opposed to late growth investments or public market investments where the company is already baked and got to a certain scale and size, and then there are genuine questions in terms of how big it can get. So that would be at least the way I would think about the opportunity in India. And if the question is, there's a lot of money, are there enough opportunities? There are lots of opportunities, especially in the venture world. We've seen a plethora of opportunities in the last 24, 30 years. There are a lot of underlying structural reasons. For example, if you walk into an IIT Delhi today, an IIT Bombay today, and ask them how many of the engineers are continuing to be in India, working in a Facebook or a Google, that number is like 10x or 20x the number of engineers who stayed back in 2004 and 5. So there are lots of structural shifts where if you go and see, you'll see there are more engineers sitting in India who are high quality. And then they are sitting in organizations where they get access to opportunity. So there's interesting micro trends because of which you should watch out very carefully.
So you mentioned trends. So 2 or 3 trends that our investors should watch out for.
Top 3 trends. Number 1, India has always had the largest number of engineers, but for the first time, a lot of the high quality engineers are staying back. It's never happened before. So the way to do the math is just go to IIT Computer Science Kanpur, top 20 people, ask them how many stayed back in India in 91, 2001 and 2011. The numbers are staggering. So that's the number 1 trend you should be worried about, because there are better quality engineers sitting in India. They will develop better products and give you an opportunity to ride. Number 2 is mobile internet penetration. It is staggering the number of people who have begun to use smartphones. And this happened, and India and Indonesia are the laggards in this, so you don't have to look very far. You look at China, you look at other markets, you'll realize very quickly that smartphone penetration will go up, mobile internet usage will go up, and therefore many new opportunities will get created.
Thanks, VD. I just wanted to move on. The other few themes that we've seen over the last 15, 20 years of investing in India is all investors are long only. And India continues to be an emerging market, therefore a lot of volatility. And volatility is a key risk that most investors face. In fact, what I have seen personally is bull market rally are actually harder and sharper. And they destroy much more wealth than a bear market going down. So Harsh, is there a space for not long only?
Definitely.
In the portfolios?
Definitely there, as a concept, having a long biased portfolio is very reminiscent in India because of the regulatory structure that we currently work under. Mutual funds, for example, are only long only structures. If today someone has to dwell into a long short or any alternate strategy, they basically have to go about doing it through professional money managers, portfolio management schemes, etc. That is one of the reasons why India today fundamentally is a long market, apart from the fact that economically also there are enough data to suggest that you should be a long only investor. However, with long only investing, you have to ride through a lot of volatility. A lot of volatility is witnessed. Where we do see a lot of problem is at the inception of portfolios. That is where volatility tends to be the most, impacts the investor or the investor psyche a lot. Let's say today I have a portfolio which starts off at 100 rupees. It grows up to 150, 200. At that point of time, volatility seems less of a problem than when it was at 100. So when you look at volatility, you cannot look at it in isolation as just numbers. There's a lot of psychology which comes into play as well. Are there strategies which can go about addressing them? Definitely yes. You have the derivative market today, which is opened up one such avenue which you can use to hedge your portfolio. You have a lot more complex instruments available to you today. I won't use the word complex, but I would say more diverse instruments available to you today, which allow you to go about managing your portfolio, especially during the inception. I feel that is where family offices or anyone, any investor for matter of fact, need to spend a lot of time. And well, if your call is that, look, I'm going to be fundamentally long, that this economy is just going to boom, there's no better way to say, okay, I'm going to be long only, buy into beta and stick through it. But you obviously need to have the stomach to ride through that. Not necessarily all family offices or individual investors, for a matter of fact, have that kind of stomach. As a professional fund manager, you obviously have to answer to your investors on a more day-to-day basis, which brings in a different type of constraints. And there are new concepts which are obviously very prevalent in the Western markets, which are coming into vogue in India as well. Absolute return strategies, quantitative strategies, which try to basically reduce the drawdown. A lot of emphasis is placed on how do I manage my volatility and then let the growth kick in.
Thanks, Ash. Are there any other factors on risk that investors need to be aware of while constructing the portfolio?
Well, it depends on which asset class you are in. One, I think a lot of us know the common risks, which are basically, mark-to-market risk, which are, fundamental risk, which are reminiscent with everything else. But I think VT will understand this better, that there's also the risk of omission, right? Sometimes it becomes one of the biggest challenges when you're trying to create a portfolio. You come across great ideas. As a family office, you have a plethora of resources available to you, but not necessarily the strategy or the structure to go about chasing or participating in the right opportunity. Or you don't want to see, if you look at what's happening right now in the public market space, everyone is like, listen, a bull run has just gone past my eyes, at least that's the perception, and I did not necessarily participate enough. That is an act of omission. It typically takes place as one such risk. From a portfolio point of view, ideally you should stay within the confines of what you know. Stick to good companies, fundamentally strong companies. Stick to strategies which you understand, and you should typically be able to take care of most financial risks per se. But I think a lot of time needs to be spent on trying to dwell on how do you go about addressing the most psychological risks which come as part and parcel of a business.
So are you recommending that even in a market as we speak today, where things are on the upswing, does capital protection have a role to play?
I think capital protection as a concept itself is the biggest risk.
Right.
I think too much has been said and done about it. Yes, certain families, at certain stages, capital protection becomes very immense. It is more circumstantial, but not necessarily the reason to go about creating a portfolio or managing a portfolio. At certain times, caution is more rewarded. At certain times, being too cautious is the biggest bane on the portfolio, right? Capital protection as a concept depends on which stage of the economy you are in, which stage your portfolio is in, which asset class you're kind of dwelling into at this point in time. These are certain things which you need to obviously look into. But all in all, I do believe that if you can go about creating a portfolio which addresses growth, even if there's volatility surrounding it, that is the best way to go about addressing capital protection. There's no point in saying I have a portfolio which has gone about adjusting, which has earned a few percentage points above inflation, but my spending trends are growing faster than the rate of inflation. It doesn't help. So you need to go about trying to compound wealth, and I'm of the firm belief, of the school of thought that creation and value, creation of your wealth is the best way to address capital protection.
Great, thank you. One last question on this, Harsh, before we move on. Leverage.
Sure.
So in a rising market, and concentration to some extent, so what role should it play in portfolios? And a lot of investors are very hesitant the moment you use the word leverage. But globally, it's been proven that concentration and leverage are two biggest drivers of returns.
I think when you dwell into the market, into leverage, you definitely need to have professional management guiding you and understanding, doing the diligence, doing the right amount of work to understand what is your gameplay. When you're dwelling into the realm of leverage, you are stepping aside merely from a long-term fundamental play into more short-term positional trends which could impact your portfolio. All right, when you get down to that level of a gameplay, you need to understand what happens or what would be my exit strategy in the event that this leverage works against me. I think more than anything else, leverage is not a bad concept. It is just that it is under-studied, under-worked upon before someone goes about trying to implement a levered strategy. We run a levered portfolio. It works well for us, sometimes it works against us. But I think what's more important is we do know at least to a fair degree we have an exit strategy in the event things go against us. And more often than not, things will go against us. It's more about creating a gameplay, understanding various scenarios, and then incorporating it into your investment style. For the people who do not have the time, energy, effort, or the understanding, they should definitely stay away from it, because more often than not, it will burn you quicker than you could stay out of it.
Right. Thanks, sir. Just wanted to move to the public markets now. Right. And I'm sure a lot of the audience is waiting to hear this part of the discussion. What are you seeing as the big trends developing? One, obviously from an investment perspective, two, from the investor perspective. So what are you seeing?
There are two types of investors: the foreign investors who have remained very bullish on India for the last 5 years, despite all the macro challenges, the political issues, and the challenges that the economy faced. And the domestic investors who have been skeptical throughout this period. And still, I think that there is some bit of disbelief, and people have been expecting that there would be some correction which will give me an entry point. I'm not very sure about that. Maybe I think something big happens in Iraq and you get a bit of correction. But broadly, I think all the ingredients for a sustainable market are in place. So what do you need for a sustainable market? You need, a macro stability. I think from a period of low growth and high inflation, I think we are just about to enter a period of high growth and low inflation. That was a bad combination. I think the right policy mix, the better execution, the governance that we are going to get, I think it's yet to sink in the overall psyche that what kind of change that we have just witnessed, I think, and what it can do to the country for next 5 or 10 years, it hasn't yet fully sunk in. So it's yet to happen. Then you need, right kind of policies, as I mentioned, that I think next several years, the way this government has got the mandate, because, people want more jobs and people want lower inflation, and for that, you need to invest a lot more in social and physical infrastructure. You need to improve the productive capacity of the economy, which means, I think, lots of opportunities, whether it's agriculture, whether it's manufacturing, whether it's services like tourism. I think there are going to be tremendous opportunities across all sectors. For the bull market, the second important thing is you need corporate earnings. So, there have been countries like China where you had high growth, but the stock market didn't deliver the returns. Of course, as a stock picker, you would have made money. But I think in India, that has been very different. I think by and large, the stock markets have been able to reflect the overall growth that the economy has displayed. So second thing you need is corporate earnings. I think next several years, in the last 5 years, we had earnings growing at 8-9%, much lower than the nominal GDP growth. I think next 5 or 10 years, we can have the long run earnings growth pattern, coming back. So maybe a 15-16% would be a very reasonable expectations. And logically, markets should deliver those returns in line with the earnings expectations. Then valuation, a starting point, markets are not excessively cheap, but I'm sure that at these levels, which are in line with the historical average, there is some bit of possibility of re-rating. But even otherwise, I think the earnings growth itself can deliver very decent returns, and as a stock picker, you can make a lot more money if you buy the right kind of stocks. And the last bit, you need sustained liquidity. You may say that, okay, I'm doing well, but somebody has to have that belief. So as I mentioned at the beginning, I think if you look at the world today, you get the Italian and the Spanish bonds trading at less than 3%. I think India is one of those places, both the fixed income and the equity market offers tremendous potential. Liquidity scenario is going to remain extremely supportive for India. Rates are going to remain low for an extended period, and in that situation, and compared with the relative valuation, whether you compare with the developed market equities or you compare with the junk bonds or emerging market bonds, I think India looks reasonably attractive, so that flow would continue. From the domestic investors, I think people sitting in this room or everywhere else in the country are massively underweight equity. So I think we are going to see a sustained flow of savings coming into the financial assets over the next couple of years, which will support the bull market for next several years. And within that, if you are a good stock picker, I think, so beta itself is going to give you decent returns for next several years. I think if you have the ability to generate alpha, you find the right manager, or you can do it yourself. I think there are tremendous opportunities next several years.
So what are the 2-3 themes that clients need to have in their portfolio?
I think everything is, so when you move from, we are at close to a $2 trillion economy. I think the way we can grow, I think we will be 4 and 8 in another maybe 4 and the 8 years time. That from the policy perspective, there is going to be tremendous focus on agriculture. We need to improve the productivity, otherwise we'll have the double-digit food inflation, and for that we'll have to have higher rates. We'll get into that. vicious cycle. To come out of that vicious cycle, we need to invest a lot more in agriculture. I think there are going to be lots of plays there. I think in terms of physical infrastructure in next several years, I think we are going to build infrastructure at a scale which has been unimaginable in the next several years. I think with the right policy mix, with a better execution, I think Japan is going to be a big partner in the infrastructure build-up. I think there's a lot that's going to happen on that side, and I think the whole industrial cycle, I mean the investment cycle is going to get revived. There's also going to be a lot of opportunity for manufacturing exports as we improve the productive capacity of the economy, investments in ports, investment in logistics, and overall I think we are making ourselves a lot more competitive the way, I mean, rupee has depreciated, and also I think companies have made the right investments. So we are going to emerge as a big, I would say, powerhouse in manufacturing exports. So the domestic investment cycle, and on top of that you get the opportunity from the global side. In services, I think tourism is going to be a big sector, but even otherwise I think our per capita, as the per capita income goes from 1,500 or whatever we have today to let's say 3,000 in the next couple of years, there's going to be a lot of discretionary spending on travel, tourism, leisure, media, and lots of discretionary spending that is going to happen. Our healthcare spending is much lower today. I think it's going to go up substantially, talked about it. So I think there are several opportunities, but there is no one holy grail of investing. I mean, you just need 30, 40, 50 stocks in your portfolio, and I think in next several years you'll have many more opportunities than probably. So it's going to be a plenty of opportunities, and you just need to choose few from them.
So a lot of investors have been asking us, stocks are already up 70, 80, 100% in some cases. So are we done for the time being? Should we book out?
Yeah, that's a problem, particularly family offices. I think you need to think of next 50, 100 years and then not the next 3 or 6 months. This is a genuine long-term bull market. I compare this with the US in 80s and 90s where they're just coming out of that stagflationary period, and you had Ronald Reagan and Paul Volcker. I think we've got Raghuram Rajan and Narendra Modi. So I think we are going to have the period of nice non-inflationary continued expansion. I think Indian entrepreneurs, I think the way we have the market structure, we have got tremendous ability to translate that economic growth into the returns that come to the minority shareholders like us. And next several years, I think, so people still have got a rear view mirror, so we are looking at the past. I think we are not looking at how this country can change in next 5 and 10 years. I think it's yet to sink in that something very, very big has happened. I think this is a tectonic shift that has happened. I think we are not realizing it. The way states and the central government are going to work together. Several other reforms that just couldn't happen for last 30 years because we got used to a coalition government and we got used to a certain way of thinking. Where the big shift is going to happen in the government policies from outlays to outcome. I mean, these are some tectonic shifts. The way federal structure is going to work that, recently I just read Rajasthan government is looking at the labor laws and the land laws, which are like the holy cows. Nobody ever thought of looking at them. If that becomes successful, and in the next couple of months, if we hear 2 large FDI deals there, I'm sure several other states are going to follow. There's going to be a healthy competition among states that who can grow at a much higher rate than the rest of the country. This is going to be a very, very different country. I think yet the realization hasn't sunk in fully. So there are going to be lots of opportunities next several years. So don't look at that one. We have this anchoring bias where we look at 24,000, 25,000. Valuations are reasonable. I think earnings growth over the next several years can give you the power of compounding.
You made a very important point around the tectonic shifts or the structural changes, and I don't know if the audience noticed that center-state relationship is one of them. So any couple of other structural shifts, because everyone seems to be so focused on the stock market, on the fiscal deficit or what's going to be in the budget. But what are the 3 key structural themes you will look out for?
So several of them, the whole thinking of the last several years, we had this focus on outlay. You spend money, whether it's NREGA, whether it's Bharat Nirman, different kinds of programs, food security, and then you boost the consumption, but we didn't realize that was not the way to grow. We have to boost our savings. I think the way savings went to physical assets because we ran negative real rates. I think the rates are going to be positive. Savings are going to get diverted to the productive assets in next several years. We are going to see tremendous amount of investments in the infrastructure. Several things. So let's say in the defense spending, we have $20–25 billion of imports. Why can't we produce it locally? Similarly, I mean, the manufacturing exports that I talked about, sustainability is going to be a very big theme. So we got, worried about the environment, and then we kind of stopped our growth in terms of the resources. But we have to think about 50-year balance between the ecology and the sustainable growth. So the investments have to happen in a very, very different manner. I think that's going to be a big thing. Energy, so let's say last few days, I mean, markets have got ripples, all markets, bond, equity, currency, because something happened in Iraq. I'm sure that every single government would have dealt it with some short-term measures that, okay, I mean, we need to deal with, let's say, the diesel subsidy, or maybe the RBI will manage the rupee. But structurally, we never thought that in 10 years' time, if US could move from a net energy importer or the largest energy importer in the world to a net energy exporter, why can't India do it? We have the largest coal reserves, we have sun, we have wind, I mean, we have huge, probably I think even lots of fossil fuel somewhere in the country. There's a lot that we can do, and who knows, in 10 years' time, we could be a net energy exporter. Just think of it, I mean, because brain thinks in a linear fashion. If India turns an energy exporter, how the balance sheet of the country looks like, but it's possible. We just need a leadership and a belief in ourselves, and I think the execution capability, which I'm pretty sure that the signs are very positive in last few days, and I'm sure in next few months and few quarters, we are going to see that.
Thanks, Navit. That's encouraging. I just wanted to come to you, Sujin. So you are obviously dealing with the alternate side of the investments, and we do hear a lot from clients or investors to look at alternate strategies. So one is this whole role of AIF regulation. Does it make sense or not for clients to evaluate? Or is it again, something being repackaged into a new vehicle? And you had mentioned to me about financial inclusion. So is there a space for allocation to something like this in our clients' portfolios?
Sure. I'll take your second question first. When we talk about financial inclusion, to put it simply, the discussion about India and Bharat, when 60% of India's population do not have a basic bank account. And yes, I share the optimism in terms of the economic growth. And when we started out in 2008, one of the fundamental focus was, what can we do in financial inclusion? There is a lot of access on the urban side. When we go to the rural side, the penetration of the financial services is very limited. We pioneered a concept called Kshetriya Gramin Financial Services, which focuses a family more from a wealth management approach. Give them loans where they need loans. Give them bank accounts where they need bank accounts. Give them investment products or insurance product or pension products. Then we started out saying, okay, we originate, we can reach few lakh people. How can we reach more? Then we started an investment bank which raises money to give to originators which focus on this space. Then we pioneered a concept called multi-originator securitization, where we can get multiple entities, pool in their assets, which makes it marketable to banks and other institutions. Recently, a year back, we moved into the space for providing investors an opportunity to participate in this market through the alternate investment fund. So, as you rightly said, there has been a lot of discussion whether the portfolio management services is now being repackaged as an alternate investment fund, and the real estate products which are being offered is now moving into this space. Yes and no. I mean, yes, there are quite a few offerings in AIF which is focused on real estate as well as on the equity space. But what we see is that there's a huge market which is opening up in AIF is also on other sustainable products. I mean, let's take a simple example of our own AIF which we have launched. We are looking at a 14–15% debt-based returns. And you also get a personal satisfaction that your money is going for a social development of the country. So this is a significant alternate class which is not otherwise mainstream. But we believe that over a period of time, we will have access to many such opportunities where family offices and other investors can invest in a very sustainable manner, which also in a way helps the entire country and helps the economy move into a single India than having India and a Bharat.
Thank you so much, Sachin. Unless there are comments from the panel, I think we'll open for Q&A. Yeah. Any questions? Sir.
first of all, congratulations to the entire panel for the excellent insights. My question is to Mr. Bharadwaj from Sequoia. What are the, you talked about the trends, the IIT, people staying behind, etc. But what are the trends you see in terms of the investment opportunities in the tech space, for example?
So I think on the technology side, we've historically looked at three types of opportunities. I think the more conventional one is, of course, on the services side, which has been, of course, a big market cap creator in India, where there are trends around specialization and more niches emerging in services as opposed to plain vanilla services, which is the ones which the big daddies, the TCS, the Infosys, the Cognizants have kind of taken and created market cap out of. But more to the services side, I think on the core technology side, we've seen three types of opportunities. The first one is India-focused opportunities. So this is India, this is using technology for India or Indian solutions. So that could be your Just Dial, that could be Naukri, that could be Zomato, that could be Flipkart. So these are basically technology-enabled companies which are still providing a service or a need focused on the Indian market and are leveraging the fact that there are more mobile users, more internet penetration, and therefore there will be more and more opportunities for such players. Some could be content, some could be services. I think the second type of opportunities we are seeing is this whole notion that because engineers are staying back and you have high quality engineers, you have the opportunity to create products which are meant for global consumption. So I call this the Israeli model. Israelis do that, and we have a venture fund, we're one of the largest venture funds in Israel, and we had a very, very good traction there, where basically you're identifying bright engineers out of Tel Aviv University, you're creating a product, and your biggest market is New York, or biggest market is the US. I think that trend for the first time we've seen, we've been here for 8 years, we've been trying to see this trend for 8 years now, but this is probably something that we're seeing more in the last 3-4 years, in terms of number of engineers from high quality places willing to step out, and already with a much better evolved understanding of products. Now, earlier the challenge used to be that these products, if you want to sell it in the US market, you have to build a sales and marketing infrastructure in the US, which is no longer required, thanks to cloud computing, thanks to so many other shifts that have happened in technology. It allows you to create a product today, sell it as a service to the US, you're able to refine your product based on early consumer feedback without the costs that would have been incurred 5 years back. 5 years back, we would say, you would need $10 million to go set up sales and marketing infrastructure and find out if the product works. Today, you can do it for 1 or 2 million. So it's a big, big shift, which is allowing that opportunity. So that's a second. The third is allied technology consumption in India. And for example, and that would be payments. Obviously, everyone knows payments infrastructure is broken. We all know that it costs either too much or it is impossible to do. And then in between, you also have a very well-meaning and a well-concerned regulator making it even more harder to make micro payments possible. With all the right intentions, but unfortunately, it's like a single solution for the entire range of problems, right? So that's a third space that has been pretty exciting for us. We in our portfolio we probably have like 5 payment companies, and similarly in software and similarly in services. So those would be how we think about the technology opportunity.
In fact, I want to provoke your thought here. So the biggest listed Indian internet company is $2 billion. And we talked about Tencent, and we keep obviously Apple and others. Will we ever see, or do you think it's imaginable to see a $100 billion internet-only company from India?
I think it is certainly possible. That's what is keeping us here. So I would say this is a little bit of the mindset, and I think Manoj mentioned it quite well, right? Which is technology is one thing where looking at the rearview mirror is the worst thing that you can do. Because you can look at internet broadband penetration in India and say, oh my God, it took 10 years to get to 20%. But then if you miss the mobile switch that happened 2 years back, you would have missed out on 10 opportunities that we think we're happy to be investors in. So absolutely, I think should it be possible? Yes. Would someone have imagined an Alibaba and a Tencent in 2001 and 2 and even 2005 in China? The answer is no, they would not have. So I think, the sheer fact that you have lots of people, the fact that I remember, this is just an aside, we looked at the disposable income, what it does to consumption. And in 2011, we had done an analysis saying, okay, you take a category like shoes and look at how much the market gap is between India and China, even though per capita income at that time was probably 2.5 times or 3 times. What you don't realize is when per capita increases from a threshold level, this number doesn't change by 2x or 3x, it goes by 10x. And that has a huge implication in terms of opportunities that show up. So yeah, I would hope so.
I have a question for Mr. Bharadwaj. When we talk about technology companies, I think there is a great deal of optimism in terms of the kind of valuations that we are seeing in various rounds of VC and private equity funding. But there are skeptics as well. There is a great deal of skepticism because if you actually look at the real P&L and balance sheet, you will see that many of them are cash burning and have been cash burning for a while. And there is this skepticism that's similar to the crash in .com. This is another time bomb, waiting to sort of, seize. So is there, what is your take on the skeptics who say that there is really no great value? You're seeing anticipated future valuation, which is leading to this mad rush, but this is a time bomb, waiting to sort of.
No, I think some of the skepticism is certainly warranted because ultimately you want business models that can work over a long period of time. We share some of the skepticism ourselves if you look at our portfolio in technology versus some others. So I think it's a little bit of we do not know how it will pan out in every case. Will some of the unit economics and some of the models ever work? We don't have an answer to that. But I think the potential reason why in technology especially it's very important to not miss something is that a very disproportionate share of the market value eventually gets captured by the winner here, unlike many other markets. So, and therefore that is the biggest thing that I would say many investors, especially in this side, worry about. Because if you finally do the analysis, you will realize that 80% of the market cap gets created in a sector by one or two players. And that's the reality of the technology because it has network effects, it has the way the business model evolves in technology allows a single person or 2-3 people to capture a disproportionate share of value. Which is why I think there is always this tension between saying, will this survive versus, are you missing something that could be potentially very, very big? So I think that is the reason why you see this tension. And some of this tension is fully justified. And I'm saying even in the US, you will see occasional bouts of worries. And then there are some indicators which say that some companies actually do well and some companies don't do well. If you look at the tech market in the US, for example, over the last 6 months, there was a correction. Where on an average basis, many tech stocks went down by 30-40%. You look back at the last 8 weeks, some of them have recovered and some of them have not. Because obviously, some of them have shown the ability to deliver on what they said and some of them have not. So I think that challenge and tension you will have. And frankly, I don't think that's true for just technology. I think it's true for many other parts of the economy. It's just that in other parts of the Indian economy, we've been so skeptical for the last 5 years that we've forgotten what it is like to be optimistic. So yeah, in 2007, infrastructure was probably as hot as technology is in some parts. So I think some of it is just our own forgetting optimism in the mind.
I actually just wanted to add to what you said, and I would encourage investors to look at NASDAQ 100, a public market, listed technology, largely technology companies, and look at the kind of performance NASDAQ 100 has given over the last 10 years. This is a period where we went with the screaming headlines, Amazon has 2 weeks of cash left, right? And we've been all through that. And look at some names I can give you, Tesla Motors. A $4 billion market cap company has gone to $24 billion in about 18 months. So this is what you mentioned, success can do for a company. And obviously Tesla has been around for over 10 years, but it just took them that inflection point. So perhaps that is the key to be mindful for when investing in technology.
You have to keep in mind that for every Tesla or Amazon or Tencent or Facebook, there are 100 who don't survive. So there's a survivorship bias. So look at the winners, but you have to keep in mind. But one single winner, even if you have in a portfolio of 10, I think you've made it.
Any other questions, sir?
My question is to Mr. Harsh. This is with regards to you mentioned the risk of omission as apart from the other financial risk. So what do you think would be the various strategies to minimize this risk of omission for the family offices?
Risk of omission, it's unfortunately one of those risks which you don't really have a concrete answer. You have an idea in front of you, you just decide not to invest in it. Tomorrow the idea becomes a Facebook. That is risk of omission, right? I think when you're diving into private investments and when you have these opportunities coming by, at the early stage, there are 2 questions which you need to ask yourself, and this is where I read something very interesting. Would this investment become a consensus after you make an investment? 2, would this business become successful? If you have an answer to those two questions, you should typically go about trying to invest or try to at least take some portion of your capital and invest into it. You do walk into these investments knowing that they are 1 and 0 games. Not necessarily do you have a private equity, I wouldn't say private equity, but it's an early stage company which isn't successful and you can get your capital back. So that's the nature of the business, right? And I think the only way you can go about trying to address risk of omission is experience. Knowing, as you know, I think the better person to ask that question would be Mr. Bharadwaj. How do they go about trying to analyze, assess what to invest into, understanding which trend to basically be a part of? And you have to be a part of the consensus early on. I think that's one way you try to basically, I would say, save yourself from this predicament.
See, the only thing I'll add is, look, and the good news here is we can look at the US markets and very evolved markets to see how they have solved for this problem of omission, right? I think there will be some parts of the market that are very deep in terms of number of opportunities you need to evaluate. But, by definition, they cannot take most of your capital because, you'll have a risk profile in mind. So venture is a good example, early growth is a good example. And then I think the answer solution for even family offices may be to say, look, I will work with some managers who will make sure that I am taken care of. Like if you look at venture as a proportion of the US endowment portfolio, it's a very small percentage. And there they almost mostly manage, reach out and say, I will tap that part of the market through managers because it's just not going to make sense, both in terms of skills as well as in terms of pipeline for me able to do that. I keep asking the question in India, for example, right? For us, we have been active investors in consumer sector for a fair bit of time. There's so many small brands emerging from various parts of the country. If you're a investor and you want exposure in that, find a manager who will invest in that sector or theme, because for you to go and do the work in each one may not be worth the effort. And therefore then that allows you to focus on asset allocation and focus on big parts of the market where you can develop understanding. So I would say take exposure. I think that's the only way to avoid omission. And of course not risking your full capital base, but taking a small amount and putting it.
Another way of putting it is maybe spray and pray.
Yeah.
You have to basically take small size bites out of these ideas, because the compounding effect of these stories are so large, it basically takes care of the risks involved. When you basically go about exposing yourself across trends, there has to be obviously some method to the madness, but typically you need to take exposure.
Right. Any other questions? I think everyone's waiting for lunch. We'll not keep you from it. Thank you so much. Thank